Hi, today's topic is all about dividend investing and how to find undervalued Dividend Aristocrat stocks. Dividend investing is a smart and time-tested approach to build wealth and generate passive income over the long term. The challenge lies in selecting the right stocks that can provide a sustainable dividend yield and solid returns over the years. It can be overwhelming to sort through thousands of companies and numerous investment opportunities. The good news is that there are strategies and tools available that can help you identify undervalued Dividend Aristocrat stocks. If this is your first time here, my name's Alan, and in this channel we talk about all things money, finance and investing. That's also what I cover in my book, The Wealth Wisdom Blueprint, which is available on Amazon. I'll leave a link to that in the description below. So, first of all, what are Dividend Aristocrats? You might not have heard of that term. Dividend Aristocrats are considered some of the safest and most reliable investment options for dividend investors due to their impressive track record of consistently increasing their dividend payouts for at least 25 years. This means that these companies have shown a remarkable degree of financial stability and profitability over a prolonged period, which is why they are an attractive investment option for many investors. Moreover, investing in Dividend Aristocrats provides investors with a sense of security, as these companies are typically large, well established and have a proven track record of success. They're usually household names that have been around for decades, such as Coca-Cola, Procter & Gamble and Johnson & Johnson, which means that they've already withstood various market cycles and economic downturns. By investing in Dividend Aristocrats, investors can also benefit from the compounding effect of reinvesting dividends. When a company pays a dividend, the shareholder can choose to reinvest those dividends back into the company by purchasing more shares. This leads to an increase in the number of shares held by the investor, and over time, this can result in significant growth in the value of their investment. Another benefit of investing in Dividend Aristocrats is that they tend to have higher dividend yields than the broader market. This is because they've got a history of increasing their dividend payouts, which signals financial strength and stability, and it attracts income-seeking investors. Overall, Dividend Aristocrats are excellent investment options for investors seeking reliable income streams and long-term growth potential. But before investing, it's crucial to do your due diligence and analyse the financial health and performance of the company, as well as its dividend growth history and valuation metrics. Finding undervalued Dividend Aristocrat stocks. Now that we have a better understanding of what Dividend Aristocrats are and why they can be attractive investment options, let's discuss some strategies for finding undervalued Dividend Aristocrat stocks. Look for companies with a high dividend yield. When it comes to finding undervalued Dividend Aristocrat stocks, one of the key strategies to consider is looking for companies with a high dividend yield. The dividend yield is calculated by dividing the annual dividend payout by the current stock price and then expressing that as a percentage. Generally, a higher dividend yield implies a greater return on your investment, which is attractive for income-seeking investors. However, a high dividend yield alone is not sufficient criteria for identifying undervalued dividend stocks. You must also evaluate the company's financial health, dividend history, and growth prospects before making any investment decision. A high dividend yield can be a red flag in some cases, indicating that the company's stock price has fallen significantly. This can be a warning sign that the market perceives that the company's future growth prospects are not promising. It's important to check the company's financial statements and assess its current and future growth prospects before investing. It's also essential to analyse the dividend payout history of the company to ensure that the high dividend yield is sustainable over time. A consistent track record of increasing dividend payouts is indicative of a company's financial strength and stability, and it can provide you with a sense of security that the dividend payments will continue to be reliable in the future. Another factor to consider is the industry in which the company operates. Certain sectors, such as utilities and telecommunications, are known for high dividend yields. However, these industries may also have significant regulatory risks that could impact their financial stability and ability to sustain dividend payments over time. In summary, a high dividend yield can be a good starting point when looking for undervalued Dividend Aristocrat stocks, but it should not be the sole criteria for investment decisions. It's essential to evaluate a company's financial health, dividend payout history, growth potential, and industry trends to make an informed investment decision. Check for a low price to earnings ratio. The price to earnings ratio, PE ratio, is a commonly used metric in stock analysis, and it can be a helpful tool when looking for undervalued Dividend Aristocrat stocks. The PE ratio measures the price of a stock relative to its earnings per share, and a low PE ratio can indicate that a stock may be undervalued. When evaluating a stock's PE ratio, it's important to consider the industry and sector in which the company operates. Some sectors, such as technology and healthcare, tend to have higher PE ratios than others, such as utilities and consumer staples. Therefore, a low PE ratio in one sector may not be the same as a low PE ratio in another sector. Another consideration when looking at a company's PE ratio is its historical average. If a company's current PE ratio is significantly lower than its historical average, it may be a good indicator that the stock is undervalued. However, it's important to also consider the company's growth potential and earnings projections, as a low PE ratio may also indicate that investors have low expectations for the company's future performance. It's also important to consider any potential risks or challenges that could impact the company's future earnings and stock price. For example, a company with a low PE ratio may be facing increased competition, changing market conditions, or regulatory changes that could impact its earnings potential. In summary, while a low PE ratio can be a good indicator of an undervalued stock, it's important to consider the industry and sector in which the company operates, its historical PE ratio, and also its growth potential and earnings projections. Additionally, it's important to consider any potential risks or challenges that could impact the company's future earnings and stock price. By taking a holistic approach to evaluating a company's PE ratio, you can identify undervalued Dividend Aristocrat stocks that have the potential to provide strong returns and income streams for years to come. Look for companies with a strong balance sheet. When evaluating a company's balance sheet, it's important to analyse key financial ratios and metrics to determine its financial health. The debt to equity ratio is a popular metric that measures a company's debt relative to its equity. It provides insight into how the company is financing its operations and whether it's taking on too much debt. A low debt to equity ratio indicates that the company has a conservative capital structure and is less reliant on borrowing to finance its operations. Another important metric is the current ratio. This measures the company's ability to pay its short-term liabilities with its current assets. A higher current ratio is generally preferred as it indicates that the company has sufficient short-term liquidity to meet its obligations. Companies with a low current ratio may struggle to pay their bills and could be at risk of defaulting on their debts. In addition to these metrics, it's important to also look at the company's free cash flow. Free cash flow is the cash generated by the company's operations after accounting for capital expenditure. A positive free cash flow indicates that the company is generating more cash than it's spending, which can be used to pay dividends, buy back shares, or reinvest in the business. When looking for undervalued Dividend Aristocrat stocks, it's important to not only consider the company's current financial health, but also its future growth potential. A company with a strong balance sheet and a history of increasing dividends may not necessarily be a good investment if its growth potential is limited. Investors should analyse the company's products or services, competitive advantage, and potential for future growth when evaluating its long-term prospects. A company with a competitive advantage, such as a strong brand or proprietary technology, may be better positioned for future growth and earnings potential. Overall, by using a combination of these strategies, investors can identify undervalued dividend aristocrat stocks that have the potential to provide strong returns and income streams for years to come. It's important to thoroughly research and analyse potential investments before making any decisions, and to keep a long-term perspective when investing in dividend stocks. Check for a long history of dividend increases. Another important factor to consider when evaluating dividend aristocrat stocks is the company's history of dividend increases. Companies that have consistently increased their dividends over a long period of time are more likely to continue doing so in the future, which can provide a steady income stream for investors. When evaluating a company's dividend history, it's important to consider both the frequency and the size of the dividend increases. A company that consistently increases its dividend by a small amount each year may not be as attractive as a company that increases its dividend less frequently, but by a larger amount. As you can see, there are many ways to find undervalued dividend aristocrat stocks. These strategies can help you identify solid companies that offer consistent dividend payouts and have the potential for long-term growth. By focusing on high-quality stocks and using a disciplined investment approach, you can create a portfolio that generates reliable income and builds wealth over time. To check a company's history of dividend increases, you can look at its dividend payout history over the last 25 years. Many financial websites and stock market analysis tools offer this information for free. You can also find this information in the company's annual reports or in its Investor Relations website. In addition to evaluating a company's dividend history, it's important to look at the financial health and growth potential. A company with a strong balance sheet and strong earnings growth potential is more likely to continue increasing its dividends in the future. Consider the company's industry and competitive position. Another important factor to consider when evaluating dividend aristocrat stocks is a company's industry and competitive position. Companies operating in industries with high barriers to entry and limited competition are more likely to have stable and predictable earnings, which can support consistent dividend payouts. On the other hand, companies operating in highly competitive industries may face more challenges in maintaining consistent dividend payouts, especially during times of economic uncertainty or market volatility. Therefore, when evaluating dividend aristocrat stocks, it's important to consider not only the current financial health, but also its industry and competitive position to ensure that it has a sustainable business model and a competitive advantage. Dividend investing can be a great way to generate passive income and build long-term wealth. By focusing on undervalued dividend aristocrat stocks with a strong track record of financial stability and growth potential, investors can potentially achieve strong returns and income streams over time. However, it's important to do your due diligence and carefully evaluate each company before making an investment decision. By considering factors such as dividend yield, dividend history, financial health, and competitive position, investors can make informed decisions and build a diversified portfolio of dividend aristocrat stocks that can help them achieve their financial goals. Of course, no investment strategy is foolproof, and there are always risks involved. It's important to do your research, diversify your portfolio, and stay on top of market trends and changes. Additionally, keep in mind that dividend investing is a long-term strategy, and it requires patience and discipline to see the benefits over time. But if you're willing to put in the work and stick to a solid investment plan, dividend investing can be a great way to achieve your financial goals and build long-term wealth. So start your research today and see if you can find some undervalued dividend aristocrat stocks that could help you on your path to financial success. And that brings us to the end of the video. I hope you've found it informative and useful. Now, it was quite complex at various points, and a lot of the metrics that I mentioned harks away back to my days doing accountancy examinations. So I know they can be quite complicated to get your head around if you're a new investor. What it might be worth doing in that case is go back and re-watch the video a couple of times and then look up any terms that you're perhaps a wee bit rusty on or that you don't understand fully. And that way you'll start to get a grasp of all the concepts that I was talking about. But if you've got any questions or comments, feel free to leave them down in the comments below, and I'll try to answer them as best I can. If you enjoyed this video, please be sure to like it and subscribe to my channel for more content on dividend investing and other personal finance topics. Thanks for watching. Remember to check out my book, The Wealth Wisdom Blueprint, and I'll see you in the next video.